Sure. Lesson one. Imagine you and a few friends start a coffee shop worth, say, $100,000. You split it into 100,000 shares, so each share is worth $1. If the shop does really well, people might pay $2 per share. Now your shares are worth more. Not because you worked more, but because the business is more valuable. For stocks like ASTS, prices move because of company performance and investor sentiment. A price drop doesn't mean the company is doomed, just that the market values it less at the moment. What matters most is asking, do I believe in this company's future? Not, will the price pop next week? First homework for the future: before buying any company, ask yourself, what does this company actually do? How does it make money? Why do I think it will be worth more in 10 years? If you can't answer, that's a sign to keep learning before investing. Next time, we can look at why ETFs and index funds are so popular, even among experienced investors like Warren Buffett.
All right. Next.
Pulling that up. Okay. This might be the most important lesson. Say you have $10,000. You could put it all into one stock, say ASTS, and hope it does well. Or you could buy an ETF that tracks the S&P 500, which means you own a tiny slice of 500 companies, not just one. If one company stumbles, the others can help balance things out. And here's something important: index funds and the indexes themselves are different. The S&P 500 is just a list. The ETF is the product you actually buy that follows that list. Lesson two: risk versus return. Generally, more risk means more possible reward, but also bigger swings up and down. There's no guarantee in investing. So, diversification helps smooth that risk. Lesson three: diversification. Instead of betting on one company, spread out across many companies. ETFs like Vanguard or BlackRock's iShares do that automatically. Lesson four: long term view. 1 month is nothing in investing. Think in years and decades. And before buying, get clear on why you own something, not just because someone else did. For now, practice that mindset. And if you like, next we can dig into the practical side, like using your Moomoo account to buy a simple ETF step by step.
Okay, let's do it.
Checking. Got it. Let's move to the practical side. So let's say you have $10,000 to invest. First question isn't which stock, it's what percentage in each type of investment. For example, 70% in a broad ETF, 20% in an Australian market ETF, and 10% maybe in individual companies you really believe in. If you're using the Moomoo app, buying an ETF is similar to buying a stock. You search the ETF's ticker symbol, check its details, choose how much to buy, and place the order. One thing you'll notice is prices move up and down daily. That's normal. Long term investors don't obsess over daily changes, they focus on sticking to their plan. A simple habit some people use is investing a fixed amount regularly, like every month, instead of trying to time the market. Over time, you can expand into learning how to research a company, basics of financial statements, dividends, and common mistakes to avoid. By the end, you'll understand what you're buying and why, not just following tips.
That was really good. So, what next?
Checking. I'm glad that helped. Okay. The next lesson is probably the most valuable of all: how to decide if a company is worth investing in. So, for any stock, ask, what does the company actually do? How does it make money? Can this business grow over the next 10 or 20 years? Who are its competitors? And is the current share price reasonable? For example, if you look at Apple, it's clear what they do. They make devices and services. You can research their revenue and competitors like Samsung, compare the price to their financial health. That's very different from buying something just because someone said, I made $200,000 on it. Those are two completely different approaches. Think of investing less as predicting the future and more as stacking the odds in your favor. For next time, I'd suggest learning how to read a company's basic financial information without getting overwhelmed. Just the key numbers you need at first.
Yeah, makes sense. Yeah, I agree with you on that. Right, next.
Checking. That's the right attitude. Asking the questions is how good investors are built. So, lesson 5: how to read a company in 10 minutes. When you look at a stock like Apple or Nvidia or ASTS in Mumu, don't panic at all the numbers. Just focus on a few. So, things like revenue, is it growing each year? Profit, are they actually keeping money after expenses? Debt, is it manageable or scary high? Cash, think of it like their emergency savings. If those look healthy, that's a good sign. But always remember, a great company can still be a bad investment if the share price is way too high. So the real skill is asking, is this a good company at today's price? For our next step, we can learn how to read that financial info without feeling overwhelmed.
Okay, let's do it.
Checking. All right, lesson 6: reading a company's financials without being an accountant. Imagine you owned a restaurant. You'd want to know how much money came in, how much you kept after expenses, how much you owe, and how much cash is in the bank. Public companies basically publish those answers. Start simple. Look for revenue growth, profit trends, whether debt levels look reasonable, and whether they have enough cash to stay resilient. You don't need to analyze every number. Even professionals begin with those basics. And here's one simple rule: if you don't understand how a company makes money, don't invest yet. That's not a bad thing. It's actually smart. Next, we can learn about valuation, like PE ratios and market capitalization, so you can better judge if something is a good buy at a given price.
Okay, let's do that. Just before that, can you please also explain in very simple language? So, the terms that we use in the investment, like the revenue and all that, just in a very simple language.
Checking. Sure. Plain English investing dictionary. Revenue or sales is the total money a company brings in before bills. Expenses are all the money going out for stuff like wages and rent. Profit is what's left after expenses. If expenses are bigger than revenue, that's a loss. Assets are what the company owns, like cash or buildings. Liabilities are what it owes, basically debts. Cash is the money on hand. Earnings per share is how much profit each share earns. Dividends are payments some companies give to shareholders. Market capitalization is the total value of all the company's shares. Volatility means how much a stock price swings up and down. Your portfolio is everything you've invested in. And terms like bull market and bear market are just overall up or down phases in the market. Those few core terms, revenue, expenses, profit, and debt, are the foundation. Once those stick, the other terms are much easier to place.
That was really good. Thank you for that. Let's move on to our previous conversation.
Sure. Yeah, that's a classic trap. The share price by itself doesn't tell you if a company is pricey or cheap. What matters is market capitalization. That's basically share price times the number of shares. That shows the total size of the company. Then there's the PE ratio, price to earnings. Think of it like buying a rental property. If a house costs 500,000 and earns 50,000 a year, you're paying about 10 times its earnings. That's what PE is for stocks. But be careful, a low PE isn't automatically better. Sometimes it actually means the company is risky or growing slowly. So the better question is, am I paying a reasonable price for the growth and quality I'm getting? That's a big mindset shift. And when you're ready, we can talk about timing, like when to buy or when to sell.
Okay, let's do it.
Checking. Great. Lesson 7, when to buy and when to sell. The truth is, nobody can time the market perfectly. Instead, many people just invest a set amount regularly, like every month. That's called dollar cost averaging. As for selling, a good rule is only sell if your reason for owning it changes, not just because the price dropped this week. Think of it like buying a house. If the value dips 10% in a month, you wouldn't panic sell, right? You'd think about your long term plan. Same with shares. One trick that really helps is writing down your reason for buying. Like, I'm buying this ETF for long term growth. Then, if the price falls, you ask, has my reason changed? Or is it just the price? That little habit can save you a lot of stress.
Yeah, makes sense. I agree with that. Yeah, the way that you are explaining, that's a good thinking. So, just before we end our conversation, can you please tell me more about ASTS and SpaceX? What are the differences and how do each company make money?
Looking that up now. I'm glad you asked. That's a great question. Okay, so AST Space Mobile is trying to basically turn satellites into cell towers in space. So your regular smartphone could connect even in remote areas. They don't sell to you directly, they partner with big telecom companies who pay them to extend coverage. SpaceX is broader. They launch rockets, they run Starlink for satellite internet subscriptions, and they do a bunch of government and commercial launch contracts. So ASTS is more of a focus bet on satellite to phone connections, while SpaceX has multiple revenue streams with Starlink already charging customers. And I guess one last thought, if you're investing for the long run, don't feel like it has to be either exciting or boring. A mix works, like keeping most of your money in diversified index funds and just a small slice in higher risk picks if you enjoy that. That way, if one speculative stock doesn't work out, it doesn't decide your whole financial future.
Okay, yep, that's right. I will do that moving forward. So, who else are the competitors for ASTS and SpaceX at the moment?
Checking. That's such a smart next question. So for AST Space Mobile, competitors include SpaceX with Starlink Direct to sell, also Amazon's Project Kuiper, and smaller players like Link Global. Traditional mobile carriers aren't exactly direct competitors, but more like potential partners that could use satellite coverage. For SpaceX, it depends which part of their business. For rocket launches, there's companies like Rocket Lab, Blue Origin, ULA, and Arianespace. For satellite internet, there's Amazon Kuiper, OneWeb, and Viasat. And here's the big takeaway: don't just ask who competes with them. Also ask what makes this company different. That's how you figure out if they've got a real shot long term. Maybe when you're looking at companies in the future, you can ask those three questions to your routine.
Okay, so what makes ASTS different then?
It's checking. That's really the key question. ASTS is aiming to let your regular 4G or 5G phone connect directly to its satellites without any special dish or hardware. So the idea is partnerships with existing carriers, not becoming a phone company itself. The bet is that billions of people already have phones, and carriers will pay to extend coverage into remote areas. The risk is huge build out costs and tough competition. What I like is how you're now asking not, will this stock go up, but what makes this business different? That's exactly the kind of thinking long term investors use when they decide what deserves a spot in their portfolio.
So how is the SpaceX different? So I mean, how is going to help humans taking rockets to the moon? So what's the purpose of people spending on that company?
Checking. That's another great question. SpaceX isn't only about rockets. Rockets are kind of like the trucks, just the way they move things into space. The money comes from things like launching satellites for other companies or government contracts with NASA. And a big one is Starlink, the satellite internet service that every users pay for monthly. The longer term vision is things like moon and Mars missions. But investors mostly see it as multiple businesses rolled into one: rockets, satellite internet, defense, and space infrastructure. That's very different from the more single focus model of ASTS. If you like thinking in portfolios, SpaceX looks like a bundle of industries, while ASTS is a focused bet. Both have opportunity and risk.
Wow, that was so great, and you told me everything that I needed to know. I think I realize I prefer and understand better when we communicate like this instead of reading. That gives me headache. So it was really fruitful to talk to you, ChatGPT, and I will come back again if I have any more questions in future. But thank you so much. Yeah.
Absolutely. I'm glad it helped. Come back anytime.
Okay. Bye.
Take care.